Megacap earnings soar. Dollar rally cools. What's next for markets? The current economic landscape is marked by a surge in megacap stocks and a notable shift in the strength of the dollar, creating waves in both U.S. and global markets. Let's dive deeper into the highlights of today's developments and what they mean for investors and economies alike. Insights from London, July 31st, Reuters. Today, key movements in the financial markets are driven by recent impressive earnings from tech giants, such as Microsoft and Meta. These companies have reported substantial gains, which propelled U.S. stock futures up over 1% on Thursday. At the same time, the dollar experienced a temporary cooldown after an earlier surge, which was influenced by hawkish remarks from the Federal Reserve, indications that suggest a tighter monetary policy could be on the horizon. The Bank of Japan echoed similar sentiments today, suggesting a collective caution among central banks. This week has been busy concerning economic statistics, corporate earnings announcements, impending trade deadlines, and crucial decisions from central banks. These factors contributed to a notable uptick in Wall Street stocks and a strengthening dollar, which reached two-month highs recently as optimism about the Fed easing slowed considerably. In fact, the dollar is positioned for its most successful week in nearly 3 years. In the following sections, I will outline today's significant market developments and delve into how the ongoing trade war is likely to influence inflation rates, particularly in Europe, potentially reviving discussions about the need for further monetary easing. Despite a better-than-expected report on U.S. GDP and simultaneous spikes in inflation and payroll data, the Fed recently indicated that it is not in a hurry to adjust interest rates again, even amidst considerable political pressure. This announcement caused expectations for year-end rate cuts to decrease, with current futures markets assigning only a 50-50 chance for a rate decrease in September. Keep an eye out for today's release of June's inflation numbers and Friday's employment report. Notably, the Bank of Japan revised its inflation and GDP predictions upwards, suggesting the possibility of another rate hike in the near future, which positively affected the value of the yen. Microsoft and Meta both reported exceptional earnings after the market closed on Wednesday, with their stock prices soaring by 9% and 12%, respectively. Investors responded enthusiastically, driven by news highlighting increased spending on artificial intelligence and cloud services. Microsoft is on track to achieve a remarkable valuation surpassing $4 trillion. Futures for both the S&P 500 and Nasdaq indexes rose more than 1% ahead of today's trading session, while stocks in Europe and Japan climbed as well. Contrarily, markets in China faced challenges, influenced by lackluster business sentiment and ongoing trade tensions. As the deadline for U.S. tariffs approaches this Friday, President Trump announced a 15% tariff on South Korean imports, a reduction from the previously threatened 25%. This new rate aligns more closely with arrangements made with Japan and Europe. However, negotiations with Canada and Mexico remain unresolved, and India is looking at a hefty 25% tariff. Brazil still contends with 50% tariffs, while China's temporary agreement with the U.S. continues but does not offer the same financial relief experienced by other countries. In an interesting twist, Trump's comments about new copper tariffs, set to take effect soon, led to a nearly 20% drop in copper prices, which highlights the unpredictable nature of such trade policies. Market Minute Highlights. With President Trump noted on Wednesday that South Korea will see a 15% tariff, a strategic move aimed at fostering better relations with this key trading partner. The trade conflict with Canada has intensified, particularly with the August 1st deadline looming for tariff negotiations, making it clear that diplomatic relations may take a hit due to geopolitical stances. The Bank of Japan revealed more optimistic inflation forecasts compared to previous months, which indicates potential interest rate hikes in the future. The European Union's ambitious commitment to purchasing $750 billion worth of U.S. energy by 2028 raises concerns about its increasing reliance on American resources while simultaneously depending on Chinese technology for its energy transition efforts. Capturing these nuanced dynamics sheds light on the region's precarious balance. Trump has notably softened some of his more aggressive trade policies and laid down frameworks for agreements with major partners. However, Brazil seems to remain the outlier, suffering from severe tariff implications. Chart of the day. Big Tech's investment in artificial intelligence is significantly on the rise, leading to larger returns and a growing interest from investors. This investment surge has driven demand across various sectors, including internet search, digital marketing, and cloud services throughout the April to June quarter. As a result, tech heavyweights like Microsoft, Meta, and Alphabet are witnessing considerable revenue growth, which also suggests promising trends for Amazon, the leading U.S. cloud service provider, as it prepares to report its earnings. Key events to monitor today. The release of U.S. personal consumption expenditures inflation data, 8:30 a.m. EDT, weekly jobless claims, 8:30 a.m. EDT, and the Chicago Business Survey results, 9:45 a.m. EDT. Earnings reports from major companies including Apple, Amazon, AbbVie, and many others. Would you like to stay on top of market developments? Sign up to receive the Morning Bid newsletter directly in your inbox each weekday morning. Let's keep the conversation going. What are your thoughts on the current trade dynamics and their impact on the global economy? Stock market news, July 31st, 2025. Dow, S&P 500, fall, Nasdaq flat, Microsoft, Meta surge. Brace yourself. Even as tech giants like Microsoft and Meta soar, the broader stock market is stumbling, and the reasons might surprise you. If you think a few big winners can save the day, think again. Here's what's really happening on Wall Street as of July 31st, 2025. Let's break it down. Today, over 2/3 of the companies in the S&P 500 are seeing their stock prices drop. Yet, thanks to impressive performances from Microsoft and Meta platforms, the index isn't falling as much as you might expect. The S&P 500 itself is teetering, down just 0.1%, fluctuating between gains and losses throughout the session. Meanwhile, the Nasdaq Composite is barely in the green, up 0.1% after briefly dipping into negative territory. The Dow Jones Industrial Average, however, is feeling the pressure, sliding 161 points or 0.4%. Here's where it gets interesting. Microsoft stock has jumped 4%, and Meta has skyrocketed by 12%. Their strong earnings initially pushed both the S&P 500 and Nasdaq toward record highs. But then, a wave of profit-taking and renewed concerns about the economy started to drag the market back down. Investors are now anxiously awaiting earnings reports from Apple and Amazon, which are set to be released after the closing bell. Will these tech heavyweights keep the momentum going, or will they disappoint? But this is the part most people miss. The rest of the market is struggling, and it's not just about company performance. The Federal Reserve's favorite measure of inflation, the Core Personal Consumption Expenditures, PCE Price Index, just came in at a 2.8% annual rate. This higher-than-expected inflation reading has made investors nervous, as it reduces the likelihood that the Fed will cut interest rates in September. For many, that's a big deal, since lower rates often boost stock prices. To get a clearer picture of the market's health, look at the Invesco S&P 500 Equal Weight ETF. Unlike the regular S&P 500, which gives more weight to the biggest companies, this ETF treats every stock equally. Today, it's down 0.5%, highlighting just how widespread the declines are beneath the surface. And here's a controversial thought. Are we too reliant on a handful of tech giants to prop up the entire market? What happens if even these leaders start to falter? Some argue that this concentration of gains is a warning sign, not a reason to celebrate. What's your take? Do you think the market's resilience is a sign of strength, or are we ignoring deeper problems? Should the Fed hold off on rate cuts, or is inflation being overblown? Share your thoughts in the comments. Let's get the debate started. Meta and Microsoft stocks surge. AI investments drive earnings growth. Astonishing growth and aggressive AI investments are reshaping the tech landscape. Both Meta and Microsoft have delivered earnings that not only exceeded expectations, but also underscored their massive bets on artificial intelligence. On Thursday, Meta's stock surged by 11% and Microsoft's by 4% after each company announced quarterly results that beat forecasts on both revenue and profit. In recent years, both tech giants have funneled substantial resources into building state-of-the-art AI infrastructure, a strategy they plan to continue. For instance, Meta now anticipates spending between $66 billion and $72 billion on capital expenditures for the full year, bumping up the lower boundary from their previous estimate of $64 billion. Meanwhile, Microsoft expects to allocate more than $30 billion in capital expenditures and finance lease acquisitions during the fiscal first quarter, far exceeding the visible alpha consensus of around $24.23 billion. But here's where it gets controversial. Analysts from Citi have pointed out that this surge in spending is likely to benefit chipmakers significantly. They noted that Microsoft represents roughly 8% of advanced micro devices, AMD sales, while Meta contributes about 2% of Broadcom's AVGO revenue. In their view, AMD and Broadcom stand to gain the most from the tech giant's amplified capital investments. Beyond these impressive capital outlays, Meta's CEO Mark Zuckerberg is leading a vigorous drive into AI talent acquisition. This push includes a staggering $14.3 billion investment in the data labeling startup Scale AI and the launch of a new division, Meta Superintelligence Labs, dedicated to advancing next-generation AI capabilities. While Morgan Stanley analysts have praised these initiatives and the strong performance of Meta's core business, they also caution that Zuckerberg's seemingly unrestrained spending in the AI arena could prove risky if the ambitious superintelligence project doesn't pan out as envisioned. Over at Microsoft, Barclays analysts are closely watching the ongoing rollout of the company's generative AI technology. Despite the fact that the scaling process is still underway, the robust demand for Microsoft's data center infrastructure signals continued growth in the coming quarters. The analysts reiterated their confidence in the stock by maintaining an overweight rating, commenting that Microsoft's outstanding Q4 FY25 results reaffirm its unique position in the software industry and its status as a favorite among investors. Digging into the financials, Microsoft posted $76.44 billion in revenue for its fiscal fourth quarter, an 18% increase compared to the same period last year. The net income climbed to $27.23 billion, or $3.65 per share, from $22.04 billion previously. In a similarly strong showing, Meta reported $47.52 billion in revenue for its second quarter, up 22% year-over-year, with its net income surging by 36% to $18.34 billion, or $7.14 per share. And this is the part most people miss. With such bold moves in AI spending and ongoing technological innovation, questions arise about the long-term risks versus rewards of these massive investments. Are these aggressive strategies a surefire path to dominance, or might they expose the companies to unforeseen setbacks? As you reflect on these developments, what is your take on the balance between innovation and risk in the tech sector?